Alright, so by now you have watched way too many videos on the ICT silver bullet, but none of them seem to work in the long run. I guarantee you this is the only and final ICT silver bullet video that you will watch. Alright, so the reason why ICT silver bullet doesn't work for you is because you don't know how to identify the internal and external liquidity, basically the intraday bias. Now, to know, you need to know the direction of the market. Okay, so let's assume that price takes out buy side liquidity, right? You must know where's the next draw on liquidity. Yes, you will win some trades when you don't know the draw on liquidity, right? But to make this strategy even more profitable and actually work, you have to identify the draw on liquidity. So how do you basically identify the draw on liquidity? It's very simple. I've explained this in my previous videos as well, but I'm going to go in detail in this video. So sit back, relax, grab your popcorns, and let's get on with the video. All right, so before we even get to the ICT silver bullet, we need to know how you can identify your intraday bias. Okay, so you can trade silver bullet on two time frames. It's 5-minute time frame and the 1-minute time frame. I personally like to trade both of them. If whatever setup is presented to me, I trade it. Okay, so let's say that you are trading the silver bullet on the 5-minute time frame. So basically, let's quickly summarize the silver bullet. All right, you can trade between 3 to 4 a.m. right, which is your London session kill zone, and then you have the New York session kill zone, which is from 10 to 11 a.m. all right, so your entries must be after 3 in the morning or 10 in the morning, and not later than 4 and 11. All right, so let's say that you are trading on the 5-minute time frame, right? You want to take your entries on the 5-minute time frame. So we need to know the direction on the 1-hour time frame. All right, so let's talk about external liquidity and internal liquidity first, and then I'm going to get into how you can actually find the direction of the market. So any high or low is considered to be external liquidity. All right, this low here is an external liquidity, and this right here is external liquidity as well. Now, what is internal liquidity? Basically, it is any fair value gap in the discount, any fair value gap that has not yet been mitigated, right? So say I have drawn my fib from here to here, and we got the 0.5 level here, which is the equilibrium, right? And then we have the fair value gap. Now that is your internal liquidity, right? And this is going to be our draw on liquidity. So we wait for price to take out the external liquidity. Once that happens, now we are waiting for price to seek the internal liquidity, which is going to be the fair value gap in the discount in this example. All right, so you simply want to wait, and this is very key. All right, this is like the whole strategy that I'm giving away. So any time of the day, look for price to take out external liquidity, right? It's going to be a high or a low on the 1-hour time frame. Once you have the external liquidity taken out, your immediate reaction is going to be that, okay, we have taken out external liquidity. Now our next draw on liquidity is going to be this fair value gap in the discount. So now what you have to do is, once price takes out the external liquidity on the 1-hour time frame, you have to look for a market structure shift on the 5-minute time frame. Once you get the market structure shift on the 5-minute time frame, that is going to confirm your intraday bias. All right, that is going to confirm that our bias for this specific time is going to be bearish. So any fair value gap that is there after 10, you take your entry from that fair value gap that forms after 10. All right, and you simply target this internal. Basically, this is going to be your target, main target, but you are only going to go for 1 to 2 risk to reward. You have to stick to this rule, okay? Because price is never, it's like not that it's going to go to the internal liquidity every single time. It doesn't happen like that. We just need to know the draw on liquidity, because price only does two things, okay? It takes out external liquidity and goes to internal liquidity, or it moves from internal liquidity to external liquidity. But we are only going to trade external to internal, okay? Because that has a higher win rate, if that makes sense. So very simple rule, guys. You wait for price to take out the external liquidity, which is basically any high or low. Once price has taken out the external liquidity at any time of the day, right, you wait for a 5-minute market structure shift. Once you have the 5-minute market structure shift, it can happen any time of the day. All right, Your entry, however, must be during the kills and hours, of course. So if let's say that the market structure shift on the 5-minute time frame happens at 9:45, your entry must be on the first fair value gap that forms at 10. Or let's say if there is no fair value gap that forms after 10, but there's a fair value gap that formed before 10, you can take your entry from that as well, because our bias is bearish. We have this draw on liquidity, and that is the key to trading the ICT silver bullet, guys. I've seen so many people trade silver bullet without knowing the bias, without knowing the direction, and that is a very wrong approach. All right, if you want to learn more about external liquidity and internal liquidity, I have a separate video for this topic. I will link it down in the video description. You can watch it and then come back to this video. So yeah, that's pretty much it about the external liquidity and internal liquidity. Let me repeat it again. We wait for price to take out the external liquidity. Once we have a purge on external liquidity, we'll wait for a 5-minute market structure shift. Once we have a 5-minute market structure shift, we are simply waiting for the silver bullet timings to hit, which is from 3 to 4 or 10 to 11, right? When that time hits, you take your entry from any fair value gap that is present, okay? It could be a new fair value gap that forms after 10, or it could be an existing fair value gap. But remember, market structure shift is very important after price takes out the external liquidity, all right? So now that we have talked about this, let's move on to the examples, and it's going to explain you more, and we'll go in detail on how this works. So yeah. All right, guys. So I'm looking at Euro USD on the 1 hour time frame. So we are going to go from 1 hour to 5 minute. Okay. So what do you see here? Okay. So we have this low here, and by the way, I have two indicators on. So one is the Asian session range, and then the fractals. If you go to indicators here, you can search up for FXN Asian session range, and for the second indicator, it's called Fractals by Rachel T. So as you can see right here, we have taken out the external liquidity. Any high or low is an external liquidity. And what do we have here? We had this fair value gap right here, right? So going into the lower time frame, once price takes out the external, right? We took out the external on 9. So let's go to the 5-minute time frame here. All right, cool. So now what we are waiting for is a market structure shift that supports our intraday bias. So we took out the external at 9:15, right? And now we want to wait for a market structure shift. So let's see. And there we have our shift in the market structure. We only want to see a wick, right? That shows us that, okay, market has the ability to go up. All right. It takes out this level. Now, what is the fair value gap that you see? There is a fair value gap right here. So our entry is going to be this fair value gap down there, right? So let's wait for price to come back into this fair value gap. That is where you're going to go long. Very simple, guys, right? You put your stop here, right? And you simply target this. I would simply target 1 to 2, but you can target this fair value gap here. That was our actual draw on liquidity, right? So let's see how this plays out. And right there, we have our take profit hit, and now see where price goes. It just reverses because we knew what the draw on liquidity was, right? Once the draw on liquidity was taken out, then we simply just get out of the trade. We don't hold the trade anymore. You will be confident in your trades when you take these setups because you know the draw on liquidity, guys. It's very important. So let me repeat this again. All right. We took out the 1 hour time frame external liquidity, right? And then we drop down to the 5-minute time frame. We look for a market structure shift. The market structure shift happens, and then we simply mark out the fair value gap that forms, and we simply take our entry from any fair value gap that presents itself after 10, right? So there was this fair value gap. We took the entry, and this happened on 11th August, Friday. So I hope that clears it. Let me give you guys a couple of more examples and then I'll end the video. All right, guys. So in this example, I'm looking at Euro USD again, and we're going to go from 15 minutes to 1 minute time frame to frame our silver bullet entry. So as you can see, we have taken out the external liquidity here by this wick right here. So where is the fair value gap? If we go down here, you can see that we have this fair value gap right there that we can target. Okay, this is our potential draw on liquidity. We are not going to hold till this level. So let me mark this out as our draw on liquidity because there is no fair value gap around here. This one is filled and every single fair value gap is filled. We want to choose the unmitigated fair value gaps. Now on the 15-minute, we have taken out external liquidity. Let's go to the 1-minute time frame and see what happened. So right here, where you can see we have a lower low, lower high, and then we have a shift in the market structure right here, happening right here. So you see this fair value gap forms at 10:22, right? So once you get a shift in the market structure, that is a confirmation that our bias isn't aligned with the lower time frame, right? Your high time frame analysis are aligned with your lower time frame. So here's the fair value gap, right? And we simply take our entry from any fair value gap that presents itself. Okay, if you haven't watched this video, you would be taking your entries without any context. You would just be entering blindly of any fair value gap that forms. It makes no sense, guys. All right, now that you know that your draw on liquidity is down there, you can simply go for 1 to 2 like that. So as you can see, our entry was triggered here and the take profit was hit 1 to 2. Very simple trade. And if we let this playing, you can see that it keeps going down. Okay, I mean, it will not always go towards that draw on liquidity, but it gives you the idea, it gives you the actual draw on liquidity where it's going to go. I hope that makes sense, right? So very simple, guys. You go from external to internal liquidity, right? You identify a purge on the external liquidity before or in between the silver bullet hours, right? And then you, let's say if you're taking entries on the 5-minute time frame, you will look for external liquidity purge on the 1-hour time frame, right? Then wait for a market structure shift on the 5-minute time frame, and then look for any fair value gap that is there after 10 or after 3. Doesn't matter. It's up to you what session silver bullet you trade. I personally trade the New York session silver bullet, but you can trade any. All right, this is like the final ICT silver bullet, guys, that you need to watch. It doesn't get any better than this. Trust me, do not watch any other silver bullet videos. Just go ahead and test this strategy as much as possible. Let me give you guys one more example and then I will end the video. All right, guys, so here is the last example. I'm looking at GBP USD on the 15-minute time frame, and this is for the London session silver bullet. So as you can see, we have taken out the external liquidity here, as you can see annotated by this indicator. And if I zoom out a bit, you can see that we have this fair value gap as our draw on liquidity. So let's see what happens. So we have taken out external on the 15-minute time frame, right? Let's go to the 1-minute time frame and study what happened. So over here, you can see we have taken out the external liquidity, right? So now we simply wait for a market structure shift, and we don't get any market structure shift here, right? In order for me to consider a market structure shift, I had to see either this low broken or this low broken as well. But price goes up again, right? It pulls back, creates a low here, and we have a market structure break, right? And then you can see that we have this fair value gap that forms here, and you could have taken your entry from here, right? Or there's another fair value gap that forms here, right? And you can have taken this entry from here. So going here, you can see we have taken our entry, stop goes above the high, and we simply go for 1 to 2, guys. Very simple, very mechanical strategy, guys. We go from external to internal every single time, and once we have taken out the external, we wait for a market structure shift that confirms the bias. Once you have the market structure shift, you simply look for any fair value gap that is presented to you, right? I would say always choose the extreme fair value gap, but you can choose the recent one and put your stop above the extreme fair value gap. It's gonna save you a lot of times. So go for 1 to 2 every single time, guys. If you have any questions about the strategy, comment down below and I'll try to answer them, but please ask genuine questions, okay? Yeah, guys, this is pretty much it. I hope you guys enjoyed today's video. If you did, hit that subscribe button, and I'll see you guys in the next one. Goodbye. Mwah.